Hi, welcome to Fill the Boot. I'm Lance, and today I want to talk about employee stock options. These things confuse both employees and employers, but in this episode, I'm going to focus on stock options from the employee perspective. I've seen few topics generate more confusion than stock options. Employees often brag about how many they have, but in many cases they don't really understand what they're worth now or what they might be worth later, and that can mean they have less impact than you might like. Now, I want to say right off the bat that this is just for educational purposes. I am in no way giving anyone financial advice about how to handle their stock options. Options are a form of derivative, and there's many kinds of derivatives that are actively used within the stock market, but we're just going to look at employee incentive stock options. So this is the right to buy a certain amount of stock at a certain price within some time frame. So the employee might have the option to buy, say, 1 million shares of the company stock at $10 a share sometime between now and December 25th, 2025. It's always going to have that time frame. And it's important to understand this is an option to buy. The employee is in no way obligated to exercise those options and actually buy the shares, but it is a right to buy. And ideally, if the price of the stock goes up, now these options are very valuable because you need to pay X for the stock, but if it's worth 10X, you've got a bunch of extra money. In early stage companies, options often make up the majority of the employee's compensation, and realistically, it's one of the only ways they're going to be able to participate if and when the company is extremely successful and has a big exit. One mistake I see is focusing on the number of options that have been granted, the number of shares that the employee has a right to buy. Because depending on what the value of the company is, what the share price is, how many shares are outstanding, that number really doesn't tell you anything. So the important thing to try to focus on is the percentage ownership of the company that those options represent, or the value of those options. And you can calculate that based on the volatility of the stock. There's a number of online calculators that will allow you to work out how much is an option to buy stock at this price actually worth right now. Now, those equations work really well for public companies because the volatility can be measured. But in early stage companies, both the value and the volatility are really hard to understand. In many cases, people just assume something like 150% annual volatility, but it's hard to get your hands around that. Now, the first handful of employees are likely to get a meaningful percentage of the company. So a co-founder might be getting tens of percent of the company. Early developers or key salespeople might be getting a couple percent of the company. Advisors and board members may be getting a fraction of a percent, say 0.5% or 0.25%. But once you start getting more than just the first handful of employees, we're now starting to talk hundredths of a percent of the company being given out as options to any one employee. The one exception to this is hiring an outside CEO or other C-suite member. When you're bringing in that kind of senior management, they're going to expect to receive a much larger option grant, even if it's later in the process. So a new CEO might be getting several percent to tens of percent of the company in options as part of their compensation. One complexity to options is that most of them vest over time. That is, just because you've been given the options doesn't actually mean that you can use them. The company might say, here's a grant. You now have the option to buy 1 million shares in the company, but you don't actually have the right to buy any of those shares of stock for a year. And at the end of 1 year, maybe you get to buy up to 25% of them. And then after that, you can buy more. In fact, that is the standard vesting schedule. The most common vesting you'll see when someone grants options is a 4-year vesting schedule with a 1-year cliff, which means when you're granted the options, you don't have the right to do anything with them. And if you leave and they're canceled, you walk away with exactly nothing. But after 1 year, 25% of them become exercisable. And so any day after that, you could write a check for the amount of that you agreed to pay for the stock and get that stock from the company. And then every month in general, over the next 3 years, another small fraction of those options vest until at the end of 4 years, you have the right to exercise all of your stock. And then at some point, the option is going to expire. Typically, option grants have a 10-year lifespan. So the first 4 years, you're earning the right to exercise them. And then for the next 6, you have them. But at the end of that 10 years, that option goes away. And the next day, you have no rights unless the company has taken some action to re-grant the options to you. Now, that's exactly the reason why vesting can actually be advantageous to the employee. A company might give you a grant every year, but if they did, they'd have to then ratchet up the price of that, right? The price at which you are allowed to buy the shares, which is also called the strike price. That has to be the fair market value of the company. So assuming the company is going up in value, then each year they'd be granting you new options at a higher strike price, which means the company needs to gain even more value for them to be as valuable. You really want the lowest strike price possible, right? If the company is now worth $10 a share, having $1 a share options is good. Having 10 cent a share strike price options is even better. Well, with the vesting, they can grant you all the options at once at the then current fair market value. And then as they vest over time, you still have that option at the original price, because these are not new grants of options. They're just, you're earning the right to actually exercise them. And then eventually the company will need to issue you new options to keep you incentivized, because once all the options are vested, then their ability to hold on to that employee is somewhat reduced. So to understand that better, let's dig into how you actually calculate the value of an option. So the option has some strike price. That's the amount you need to pay to buy a share. And there's some current market value of those options. So if the company's been doing well, the current value of the stock is higher than the strike price. And so at some level, the value of the option, if you were to exercise it right now, is simply that difference. It's the number of shares you could buy times the difference between your strike price and the actual cost. Now, if you can't actually sell the stock, then that's a little theoretical, because yes, you did get stock cheaper than it's currently worth, but you can't turn it into cash. You just have stock at the end of the day. Now, some companies will agree to buy it back. If it's publicly traded stock, then there's a market and you can easily transact that. You can immediately, as soon as you exercise those options, you can then sell the stock on to someone else at the current market value and get the cash in hand. But if you're planning to hold this for some time, then there's also a time value to it. So even though, let's say, the day you're issued the option and the fair market value and the strike price are exactly the same, technically that share is worthless, right? That option is worthless, because if I were to sell it, I'd be buying the stock for exactly the normal price. So that doesn't do anything special for me. But we know that the company has a good chance of appreciating in value, and it's never going to be a negative value on the option. An option's never worth less than nothing. But because there's some volatility in the price and companies tend to grow, that option, even the day it's issued, has value. And if you assume 150% variability or volatility rather, in the price of the stock, then the Black-Scholes equation will spit out that in fact, that option is worth roughly its strike price. But that has nothing to do with what it could be worth. You're given an option at $1 strike price. When you finally exercise it, or the company exits or goes public or gets acquired, that could easily be $1,000 fair market value per share or more, or in fact much less. So there's the potential to have a huge windfall. And when you're thinking about how much your options might be worth, you might want to look at it in terms of percentage of ownership. I own this much of the company. If I think that companies in this space are exiting at this sort of valuation, they're tending to be going for $500 million, then my tiny percentage of that would be worth X. And that can give you a sense of how big this could be. And if you find out that it just isn't that much, right? They've given you such a tiny slice of the company that it doesn't add up to anything interesting, that suggests maybe these options aren't all that exciting. So when you choose to use your options, exercise the options, technically what you need to do is actually fork over the price that you agreed to pay. So if you have 1 million options at a $1 strike price, in theory, you need to pay the company $1 million to exercise them. And many people don't have that. So in a lot of cases, companies will give a different option to the employee. They'll say, if you want, you can do what's called a cashless exercise. And what they'll do is they'll look at what's the current value of the option. What's the difference per option between your strike price and the fair market value? And then say, what we'll do is we'll just cancel a number of options equal to the cost of exercising all of your options, and then just use that to give you the stock for the rest. So effectively, it allows you to buy the stock with the options themselves, and you don't have to pay cash out of pocket. You'll still have the same tax consequences as though you had paid the money and gotten the stock. But if a company wants to be nice, and having a reputation for being nice certainly makes you more attractive to employees, they will offer that ability to do a cashless exercise, so employees are not out of pocket some huge amount of money, and people who don't have the ability to pay that on a dime can still benefit from the options. One thing to remember about options is that in many cases, the holder owes taxes on the capital gains when they exercise the option. And in the example I was talking about before, where you don't have publicly traded stock, you may not be able to sell it. So in some cases, you'll find a situation where you exercise the options and you now on paper have made, say, a couple $1 million. You now owe taxes on that couple $1 million of capital gains, right? The difference between the strike price and what you actually have the stock worth now, but you can't turn it into cash to pay for the taxes on that gain. So this creates a complicated situation where you're going to want to think carefully about if and when you exercise those options. Or are there other ways that you can finance it? Can you get a loan? Will the company sometimes loan the employee the money to cover their taxes that will be paid for when eventually they can sell the stock? A lot of things need to be done, but if you actually have a bundle of options with substantial value that, were they exercised, would cause an unacceptable tax burden, you really need to be getting an accountant involved. In fact, anytime it's more than a trivial amount of options, super important to talk to accountants, because the tax laws around options, how much you can exercise, how fast you can exercise, what kind of tax treatment it gets depending on how long you've had them, how long it's been since you exercised them before you sell the stock, all of these things are tremendously complicated and changing frequently. So do yourself a favor, before you make any decisions, go talk to an accountant who is experienced in dealing with options. Thanks for watching. I hope you found this interesting and useful, and if so, please like and subscribe, and then click the bell icon to be notified every time new episodes become available. I upload new content every other week, and I'd love to hear from you what topics you'd like me to cover. Please let me know down in the comments. Till next time, ciao.